Ladies and gentlemen, welcome back to the channel. Here in this video, we will go over my expectations for tomorrow around the economic data that we get, which is by far the biggest data in the month of September. That is the unemployment rate. That is the non-farm payrolls report. And I'll just give it to you straight right here, right now. I think the data was leaked again. Now, my track record of reading the tape, if you will, for these recent data leaks has been pretty good. Yesterday, I said there was probably some news coming for Tesla because of how Tesla was trading relative to the rest of the markets. What happened today? We got big news for Tesla. I think you're seeing a data leak yet again today. And it may not be good tomorrow morning. So I think this video could not be more important. It is a very time-sensitive video, and hopefully you guys take this with a grain of salt, because I could be wrong. Maybe it's just pre-data jitters. Maybe there was no leak, but judging off of markets today and how we traded, yeah, I personally think there was a leak. Let me know what you think down below in the comment section, your opinions around the data coming out tomorrow. Now, we also got some data today that suggests tomorrow's non-farm payrolls report is going to also come in low. The ADP report, this is the private payroll report, not the government data, the private payroll report that has really built up its credibility and respect and overall longevity over decades and decades and decades of providing this data. The ADP report always comes in before non-farms. There tends to be some correlation with the two, but this report came in at 99,000 job ads. We were expecting around 145,000 job ads. So this was far below estimates. Now, in fact, this ADP report was the worst report since 2022. The lowest report. That doesn't sound good. We also got the ISM services PMIs that came out today. While the headline number beat a little bit, business activity came in sharply lower than expected. Employment came in lower than expected as well. New orders did come in better than expected, and prices paid came in higher than expected, but business activity coming in low, not good. Employment coming in low, specifically heading into tomorrow, that's also not good. Now, the ADP employment change is the biggest data of really today in terms of the labor market and what the read-through could be to tomorrow's non-farm payrolls report. Even last month was revised lower from 122,000 job ads to 111,000 job ads. So you are seeing the labor market definitely experiencing some weakness here. And if that translates into tomorrow's non-farm payrolls and potential weakness, that's a problem. And I will tell you right now, expectations are kind of high. So non-farm payrolls are expected at 160,000. Some firms are 200,000 or more for their estimates. Some firms are as low as 120,000. If we come in under 140,000, Wall Street's not going to like that number, okay? But really what is going to drive markets is that unemployment rate. We are expecting the unemployment rate is going to fall to 4.2%. It's currently at 4.3%. So we are actually expecting the unemployment rate will fall. If it goes up to 4.4%, that's clearly not good. That clearly would not be good at all. But if it goes up 0.2% to, let's say, 4.5%, then we're going to be up shit's creek quickly in markets. Okay, like, that's going to be really bad. That's actually what happened last report. So for 4 reports in a row, we were getting a 0.1% uptick each time for the unemployment rate. Until last month, where it went from 4.1% to 4.3%. If it goes from 4.3% to 4.5%, we're in trouble. If it somehow goes to 4.6%, like if we see another large jump, yeah, you're going to have a circuit breaker tomorrow. You're going to have a 7% down day, almost guaranteed in my personal opinion. because that would be so far away from what Wall Street is expecting. It would almost be like a black swan event in and of itself, because Wall Street's expecting the rate will actually fall. The unemployment rate will actually fall. So I think there is some real risk for the downside heading into tomorrow. Whereas I think there is a chance of upside as well. If things do come in good, the unemployment rate does fall. Maybe it falls a little bit more than expected. People are going to get more excited around the soft landing, and I could see a 3% up day at the same time. But I could see twice as large of a down day if it surprises to the upside and the unemployment rate goes up. A 3% up move from right now, from current prices, would be getting back to about 565. A 7% down move from current prices would take you lower than August 5th. It would take you to about 509 on the SPY. That would be a crazy move, okay? And that is obviously not my base case assumption. Base case assumption is maybe half of that if we do have, just a 1/10 uptick in the unemployment rate. Yeah, we're still not going to like that, but it's not going to be a huge collapse. But that's the kind of volatility that I'm expecting we could see out of tomorrow. And judging off of how markets traded today with, the data came out, the ADP report came out, the ISM services report came out, markets actually ripped higher on these reports. Markets were actually positive. They actually went higher, like with good momentum, good breadth, and then it just stopped and came crumbling lower. That's not a good sign heading into tomorrow. And potentially that is when some big money investors started to actually get the data. Now, keep in mind, I think the firms that are actually getting the data early are these systemically important firms. This is Citadel, Jane Street, State Street, BlackRock, Vanguard. These are your major banks. These are not small hedge funds and institutions. These are the biggest of the big dogs, because I think at this point we can't have a systemic risk. And if you are going to get a really bad or really good number and these big firms are not positioned for that, there could be big losses and big problems. And that could spew over into economic problems as well. And I think the last thing anyone wants right now is a market-induced recession. So I'm actually leaning towards a non-farm payroll report that does see the unemployment rate at least tick up to 4.4%, if not 4.5%, and to see in the neighborhood of 2 to 4% downside tomorrow. That's what I'm kind of reading through from the markets. That's kind of the setup that I see. You've already started to roll over before this report. That tends to happen, before we get a larger kind of drop, is you do tend to see this rolling over that starts anyways. So that's more my baseline forecast. Now, is it possible the unemployment rate falls and jobs reports come in good? Sure. But the data we've gotten this week around the labor market has not been good. It just, whether you're looking at manufacturing employment, services employment, they both missed and came in lower than expected. The ADP employment change missed and came in lower than expected. The data last week was also not good on the labor market. So I think collectively, when you look at these things, we don't have a super optimistic outlook heading into tomorrow. Now, on a technical basis, the S&P is going to likely find some support around 544, as long as that report is not too bad. If we don't, then you have a larger gap to fill down to about 537. 537 from current prices would be a drop of about 2%, which is around my base case assumption for tomorrow if that data does come in just worse than expected. Not terrible, but just worse than expected. And if I am wrong and markets do go higher, then I will own that. And I do think the upside here is, on a really good report, 2 to 3%. That's going to put you back to where you were trading at the end of August, just really over the last couple of weeks. You're not going to break out past that, in my personal opinion. It's going to be hard to get over 3%. But if we do, then you're looking at brand new all-time highs in markets. And that's what I think is on the line with this report. A potential 10, 15, 20% correction over the next couple of weeks, or new all-time highs. And what markets will deem as a true soft landing. Like, I don't think there's been one single data point this important before. Not at least in this cycle. Like, literally, say that out loud again, or at least I will for you. I think this single data report right before the Fed cuts rates could either give you a 10, 15, 20% correction, or bring about new all-time highs, maybe a 5 to 7% rally from here. Could it be a little bit more than that? Of course. I think it would be more than that under the surface. I think a 5 to 7% rally for that headline S&P is pretty generous, because I don't think big tech's going to participate too much. So I actually think 5 to 7% rally in the SPY could mean a 10, 15, 20% rally in small caps. I think it could mean a similar rally in cyclicals and value and some dividend names, high quality dividend names for that matter. So I actually think under the surface, you could see a much larger move than 5 to 7%. If you're looking at the SPY, I think it's going to underperform if we do actually confirm that soft landing. So actually, I think both directions could be large based on this data that we get tomorrow. And that's exactly what I've said for a while now for Tesla stock. If this Friday's report is good and markets go higher, no, I'm not expecting 5 to 7%. I'm expecting 25 to 35% for Tesla. I mean, from current prices, 15% higher is going to put you at about 264. If we zoom this out a bit, 20% higher is going to put you at about 276. 25% higher is going to put you at about 290. And 35% higher from here is going to put you at about 311. And I think that could happen in the month of September if the data comes in good tomorrow. And I think that's obviously exciting, but I do think the downside here could be 15, 20% in September if the data comes in bad. I don't think one data point is going to draw the ultimate conclusion of recession. Tesla's not going to fall to $100 per share based on tomorrow's data, but could it send you back to 184? Yeah, that would be a 20% down move from here. That would be the low that you've seen roughly on August 5th. That, my friends, is certainly possible. And that is the potential risk that we need to be positioned for as a possibility and mentally prepared for as a possibility as well. I also think the percent of stocks currently trading above their 50-day moving average at about 50% supports either direction as well. I think there's a lot of room for internal strength to come into markets, a broader, larger rally. And I also think there's a lot of room for downside as well here, down to 15% of stocks trading above their 50-day moving average. That's typically what you see towards the end of corrections. I mean, you're at 50, 51% today. That's a lot of potential pain that could come. And to the upside, you usually get to like 85 to 90% of stocks trading above their 50-day moving average during really good rallies, and you're only at 50%. So I do think there is room in either direction here. If you look at CNN's Fear and Greed Index, that is neutral at 47. I mean, we could go into extreme fear territory, and that would be a lot of downside, right? That would be a really bad day, really bad couple of days. Same is true to the upside as well. To go into greed or extreme greed, you could see a couple really good days as well. And I think there's room to go in either direction here. What's fascinating about the latest AI investor sentiment survey that came out yesterday, bullish investors sit at 45.3%, which is down from 51.2% last week. Bearish investors fell as well. So bullish investors fell and bearish investors fell from 27.0% to 24.9% of investors that are bearish. Neutral investors jumped a lot from 21.9% to 29.8%. And I think that highlights exactly what I'm saying here in this video. Nobody really knows what the data is going to be like tomorrow as far as retail from a broader market perspective. But we do know that it's going to affect the markets a lot. And people When they don't know, they just tend to be neutral. I do think small hedges right now makes a lot of sense with the kind of downside that we could see tomorrow. Could, not guaranteed, but could see tomorrow. And I think cash is king in this market environment. So let me know what you think about this information down below in the comments section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.